Hi, and welcome to Arnerich Massena's second quarter 2018 MarketCast. Unlike the past 2 years of smooth sailing, 2018 is shaping up to be an unpredictable year for investors, choppy, mixed, and full of reversals. For example, the US dollar and US stocks, which lagged in the first quarter, were the best performers in the second quarter. The dollar rallied with a favorable environment of increasing growth, rising interest rates, greater inflows of overseas profits, and safe haven buying in response to global trade tensions. These in turn lifted US stocks into positive territory for the year. But for non-US stocks, which were the best performers in the first quarter, the second quarter was disappointing. Fears of tariffs and rising interest rates drove developed and emerging market stocks lower. Meanwhile, US bonds held fairly flat, while global bonds lost ground against the rising dollar. Looking at economic growth, we can see the US economy pulled ahead of Europe and Japan, with strong US consumer spending and business investment spurred on by a healthy labor market and tax cuts. Meanwhile, in Europe, growth seems to have moderated. In June, the European Central Bank cut its 2018 growth forecast and indicated it would likely hold down interest rates through at least the summer of 2019. And in China, growth also appears to be cooling as government measures to rein in corporate borrowing have cut into credit growth and infrastructure investment. The strong US economic growth is also evident in the unemployment chart, which shows US unemployment closing near an 18-year low at 4%. Or, if we include part-time and discouraged workers in the calculation, the unemployment figure comes in at 7.8%, also a very low figure. As a result, workers have been drawn back into the labor force, and the labor force participation rate appears to have leveled off after decades of decline. Oil and gasoline prices jumped much higher in the second quarter. Oil rose 14% due to strong demand, supply disruptions in Venezuela, Angola, and Libya, and the prospect of tighter sanctions on Iran. The price of gas followed suit, rising 7% to its highest level since 2014. This raises the risk that higher energy prices could cut into consumer spending or lead to inflation, possibly resulting in tighter monetary policy. The combination of rising trade tensions, rising oil prices, and the rising dollar was particularly stressful for some emerging economies, which had to contend with investors' demands for higher yields. Against this backdrop of inflation worries and currency weakness, several emerging market central banks decided to raise their short-term interest rates during the quarter. Here at home, in June, the Federal Reserve raised the target range for the Fed funds rate by 0.25% to a range of 1.75% to 2%. The Fed expects the Fed funds rate to rise to almost 3.5% by 2020, but futures market participants take a softer view and expect Fed funds to stay below 3%. Either way, there's risks. If the Fed raises too little, inflation could occur. If the Fed raises too much, a recession could take hold. However, judging from stock valuations, investors weren't too worried about the possibility of a recession. In the second quarter, both US growth and value stocks were trading at price-to-sales levels above their historical averages. Large-cap growth stocks were trading at 3.1 times sales, and large-cap value stocks were trading at 1.6 times sales. FANG stocks in particular stand out, some of them with very high valuations. While making up 12% of the S&P 500 index, Facebook, Amazon, Apple, Netflix, and Google accounted for 83% of the S&P 500's return during the first half of 2018. The concern here is that highly valued stocks depend on future earnings growth to justify their share prices. Amazon, for example, is trading at a price-earnings ratio that is roughly 10 times the market average. At its current price, it would need to pay out all of its earnings, if it continued to earn at the same rate, for about 268 years in order to cover all shareholders' investments at today's share price. When it comes to our tactical views, we're continuing to focus on the undervalued parts of the market. Among stocks, we believe the most attractive valuations can be found abroad, so it's our view to overweight international equities versus the global benchmark. We're also continuing to find value stocks more attractive than growth stocks. And with short-term interest rates having risen and credit spreads still narrow, we favor lower duration bonds and limiting exposure to lower quality credit. Your advisor will keep you informed as specific investment opportunities become available. For more information, please subscribe to our blog at arnerichmassena.com. Thank you for joining us.